Stock market collapses are rarely ever triggered by one headline. They usually come from something called stacked stress. Stocks themselves are rarely the biggest issue. The real risk is actually credit markets. What really happens when there's a global stock market collapse? So when people talk about stock market collapses, they typically imagine red charts, falling portfolios, the world's ending. But the truth is, if global stock markets collapse, it's rarely just about stocks and shares, as you can imagine. It affects banks, property, governments, and pretty much everyday life. And right now, with geopolitical tensions increasing significantly, especially here in the Middle East, understandably, a lot of people have questions, and the main one being, could this trigger something a lot bigger? So what I'm going to do in this video is I'm going to walk through what actually happens when markets have collapsed. Typically in the past, cycle to cycle, they do vary naturally, but we can go through what it would typically be the real economic chain of events, and why periods like this that we're currently experiencing at the minute feel a lot more dramatic than what they actually are. So for those of you who don't already know who I am, I'm Dan Thompson. I'm a chartered wealth manager and multi-business founder. And for well over a decade now, I've been advising high net worth individuals and companies on both their business and their money. And over the past few days, as you can imagine, I've received a lot of messages, emails, calls from clients, business partners, friends, understandably concerned about the headlines. And particularly those that are living out here in the Middle East, where the situation without a doubt has felt a lot closer to home. So this video, just to be clear, is not about predictions. It's about understanding cause and effect, especially based on what has happened in history and how markets actually behave when there are periods of geopolitical uncertainty. So when there are periods of geopolitical tension, naturally short-term market volatility follows. And what we're seeing right now is actually fairly typical of how markets behave in these kinds of situations. Because when tensions rise, specifically here in the Middle East, several things tend to happen almost immediately. So oil prices move up higher, safe haven assets like government bonds, gold, and the US dollar tend to strengthen, and equities, so markets tend to modestly drop back. And that's exactly what we've experienced. And the reason is really simple. The Middle East is a crucial role in global energy supply. And to be more specific, for example, the Strait of Hormuz, which is obviously a hot topic right now, a big talking point, it's a narrow shipping channel that is partially controlled by Iran, but responsible for carrying about 20% of the global oil supply. So when tensions escalate in the region, naturally investors all over the world are concerned. They're trying to assess whether energy supply is going to be disrupted both in the short and the long term. And what we've seen so far has actually been quite a measured reaction, because markets are responding, but they're not panicking. And policyholders around the world will be watching developments very closely right now. So what triggers a real global stock market collapse? Now, interestingly, stock market collapses are rarely ever triggered by one headline. They usually come from something called stacked stress. So this can be things like credit tightening, too much leverage in the system, banking stress, policy mistakes like interest rates being too high for too long, or in this case, a geopolitical shock. The real driver underneath all of this is confidence, investor sentiment. That is what drives markets. And when confidence holds, markets can typically absorb the shocks and there's very little volatility. But when confidence breaks, like it has done recently because of the number of events that's happened geopolitically, markets can reprice very quickly. So when a genuine collapse starts, what tends to happen is the first phase tends to be sharp, it tends to be quick, it tends to be brutal, because typically when we look back at history, equity markets have fallen quite sharply, 30, 40%, sometimes even more during major economic events. But markets don't fall because the world's ending. They fall because future cash flows become uncertain, they become unpredictable. And investors naturally start asking questions like, will companies still continue to grow? Is the economy going to slow down? Will consumers continue to spend? And growth stocks and speculative assets tend to fall first. Dividends can get cut, buybacks can stop, and then companies can be raising capital at typically more difficult valuations. But stocks themselves, markets, equities, whatever you want to call it, are rarely the biggest issue. But the real risk is actually credit markets. And this is something that people typically miss, because credit markets actually matter much more than stock markets. Because when credit freezes, what happens is companies struggle to refinance debt. Bond spreads widen dramatically, and even healthy businesses can face survival risks. So what's interesting is stock markets or crashes in stock markets are actually more visible. But when credit freezes, it's less visible to most people. And this is what actually can break companies. And that's how financial stress actually spreads into the wider economy. So this is where financial stress becomes a broader economic problem. This is known as second order effects because banks become more cautious naturally, loan defaults rise, lending tightens, and when lending tightens, economic activity will slow down and you'll start to see things like hiring freezes or layoffs or property transactions slowing down or consumer spending naturally dropping off. And often the confidence that shocked consumers, businesses, tends to last longer than the actual market drop-off itself. So next we typically see the government response. And at this stage, this is where governments intervene and not always for the best, right? Because systemic collapse is politically unacceptable to typically most governments. Historically, we see emergency interest rate cuts, fiscal stimulus, quantitative easing, central banks providing liquidity injections, and as a result, debt levels rise because policymakers will always choose stimulus over collapse because in simple terms, they would rather create inflation and debt than see the system fail. Now let's talk about other asset classes. Property, this typically reacts later. Transactions collapse first, prices then tend to soften up. Highly leveraged owners can become distressed sellers, and prime or scarce property tends to hold far better than more speculative markets. Cash, on the other hand, during a crisis actually becomes more valuable because it provides flexibility, it provides optionality, it prevents forced selling. However, holding cash for the long term carries its own risk: inflation. Gold, on the other hand, typically falls during a major market event given there is panic selling involved. However, in certain events like we're experiencing right now, it can be a safe haven asset and gold prices can actually rise. So every market event does naturally differ, but historically it benefits when confidence in currencies or policy even weakens. Gold, however, isn't a growth asset, it's more of a confidence hedge. Right, so commodities, and more specifically industrial commodities, these usually fall as a recession risk rises, energy demand naturally weakens, and when stimulus eventually arises, commodities often rebound strongly. But as you can imagine, this varies economic event to economic event. And as we're experiencing currently here in the Middle East, with the potential supply of energy being under threat, being reduced, that is naturally having the reverse effect on things like oil and gas. Crypto. So despite the narrative, crypto as an asset class tends to behave like a risk asset that's in acute panic. It usually falls early. Long-term outcomes depend on whether the crisis becomes a trust in the system. Crypto is typically, a relatively new asset class. And as a result, there isn't a lot of long-term data on it. And it tends to kind of be unpredictable when there's global stock market events. So this is the part that a lot of people really misunderstand, the longer term effects, because wealth is not destroyed in crisis, it's just transferred. Weak companies disappear, yes, but then other amazing opportunities, amazing companies come out of it as a result. And this is so true when you look back at some of the top companies in the world that exist today. They were born out of crises. Because a strong balance sheet can buy assets cheaply. Inequality often increases. Yes, new regulation often follows, but historically, when the worst moments feel like the end, this is when the best opportunities tend to come along. They're created in these moments. So what does history tell us? Because despite how unsettling global market collapses can be, or major geopolitical events like the one we're experiencing right now, history does give us some perspective. It does give us a really good lens in which to view things, because markets have navigated wars, geopolitical tensions and conflicts like the one we're in at the minute, financial crises, economic shocks, and there's been many of them over the past decade alone. And interestingly, studies that examine long-term market data show that periods of geopolitical tension lead to short-term selling. What a surprise, right? So that period of selling can temporarily push down valuations, so they're lower than what they were previously. And paradoxically, that can actually improve long-term prospects for more disciplined investors that stay the course. Not because conflict is necessarily good for markets, but because short-term fear can push down valuations, the underlying value of a company, the intrinsic value, the true value, and that can provide a better entry point for other investors. What doesn't happen when there's a massive market event or global uncertainty? The world doesn't stop spinning, capitalism doesn't end, markets don't stay down forever. Every major collapse in history without fail has been followed by innovation, reflection, and a new expansion cycle. So understanding investment philosophy is absolutely critical, and this is precisely why long-term investment strategies are built the way they are. The principles remain consistent and have done for a very, very long time because diversification across regions, asset classes, sectors is always a good idea. Long-term planning anchored to personal financial goals. And experienced investment managers, fund managers, they continuously monitor risk and opportunity and take advantage of it, especially in times of uncertainty, in times like these, because during geopolitical events, market movements are often driven more by sentiment than underlying fundamentals, because reacting emotionally can make it harder to actually benefit from the recoveries that historically follow. So you want the truth, right? And here is the real risk. Market collapses punish leverage, overconfidence and short-term thinking. But what they also do is reward liquidity, diversification, patience and emotional discipline when it comes to investing. The real risk isn't market volatility, it's being forced to sell at the wrong time. Right guys, so just to wrap up, periods like this I appreciate can feel unsettling, especially when there's a global stock market event or there's geopolitical tension and uncertainty, and media headlines can be intense to say the least, especially at the minute here in the Middle East. But volatility is a normal part of investing. Well-constructed portfolios are designed to navigate environments like this and, more importantly, take advantage of the opportunities that present themselves. And allowing returns to compound over time while keeping your long-term objectives firmly in focus is absolutely key. For most investors, the right response during periods like this, and it's normally the hardest one emotionally, is just to stay disciplined and stay the course and let professionals, wealth managers, asset managers, fund managers do their job. Because history consistently demonstrates that markets recover, but those who remain invested tend to benefit the most from a recovery. So the key takeaway from today's video is this: learn how sophisticated investors position their portfolios before there is a crisis. Learn what tends to outperform when there is a recovery, and how to structure your personal balance sheet, so things like cash, investments, property, to survive or capitalize on a downturn. Now, if you like today's video, please like and subscribe. I want to keep producing content that is calm, rational, practical, and focused on long-term thinking.